The Housing Development and Financial Corporation has posted a net profit of over 8,000 crores in the quarter ending December 31st, 2019, compared to a profit after tax of over 2,300 crores in the quarter ending December 2018. We have Keki Mistry, Vice President and Chief Executive Officer of HDFC with us. So we'd like to run through the growth numbers for the company. Overall, the loan book has grown about 14%, and the individual loan component has grown up by about 16% year on year. Obviously, which segments were the main growth?
So our focus has always been on individual loans. We have consistently over the last 6 quarters told our investors that we would be focusing more on individual loans, and we continue to remain cautious on non-individual loans. Individual loans AUM growth has been 16%, non-individual AUM growth has been 6%, giving us overall AUM growth of 14%. So that's the broad macro. If you look at the average loan size for individual loans, it used for, if you look at only the first quarter in isolation, it was 27,70,000 rupees. Second quarter was 26,60,000 rupees, and third quarter saw a further reduction to 26,50,000 rupees. So the growth has come largely on volume, on number of applications, rather than on increase in the average loan amount. And it also shows that demand for high-priced apartments, the expensive apartments, has slowed down. But in the affordable housing segment, the demand continues to remain good.
So in terms of proportions in the individual loan book, the premium or the high-ticket loans, what percentage
would be relatively very small now.
Okay.
So if you look at the affordable housing loans, in value terms, it is now 18% of our disbursements, and in number terms, it's as much as 36% of our disbursements. So 36% of the loans we did in the current year were to customers who would fall within the economically weaker section or in the lower income category.
So post the collapse of the infrastructure leasing financial services group in September 2018, right, there's a lot of questions that were thrown about housing finance companies. I understand that HDFC did not have an asset liability mismanagement or mismatch that many other companies did. But I just wanted to understand, how do you see the environment? There's a lot of talk that there could be defaults in the real estate sector by developers. Have you seen that happen, and what is your outlook? How do you see the credit situation, at least from
my sense is that if you look at the NBFC sector or the housing finance sector, as you put it, in the early part when the ILFS crisis happened, there were two issues. One was liquidity. Liquidity was tight in those days, and the other was risk averseness. Today, liquidity is not an issue. The RBI has very rightly, very correctly infused huge amount of liquidity in the system. So there is no concern as far as liquidity goes. Risk averseness definitely has set in. So there is a reluctance on the part of banks and lending institutions to give money to every NBFC. So NBFCs are now clearly categorized into very strong, not so strong, weak, and so on and so forth. And the weaker and the not so strong NBFCs are finding it very difficult to raise money. This is more a function of risk averseness. Default you are talking about, look, default is always going to be a risk. Non-performing loans is always going to be a risk. But what you must understand is that financing of real estate is very different from financing for a car or financing for a vehicle or financing an industrial project, because the security value of the loan is always the real estate, and whatever be the conditions, real estate has a value. So whilst technically loans can become non-performing loans, and as you said, delay in making payments and defaults, risks of major losses in the real estate sector to that extent are very limited.
In terms of HDFC strategy in the past year or in the last 6 months, what has the strategy been in terms of your existing construction projects that you're funding?
Our strategy has been to grow the individual business, to be very cautious with non-individual business, which is reflected in the fact that if you were to look at it on a balance sheet basis today, individual loans constitute 76% of our total loans, construction finance constitutes 11%, lease rental discounting constitutes 8%, and corporate loans constitute 5%. This is on a balance sheet basis. If you were to look at this number incrementally for the third quarter, only for the third quarter, individual loans constitute 81% of the growth, non-individual loans constitute 19% of the growth.
So that's been reducing over time, the non-individual component.
Yeah, if you were to look at it for the 9-month period as a whole, then it would be 90% individual loans and 10% non-individual loans. So clearly over the last couple of years, we've seen that the focus has largely been on individual loans.
In earlier conversations, we were talking about last mile financing being the biggest issue for real estate developers, especially in this environment where NBFCs don't have liquidity to lend. Has that situation improved? Do you feel that they have?
To be very honest, no. I don't see the situation has. I wouldn't say the situation has improved. You see, when a project is stuck, because it's done 70, 75, 80%, let's understand why that happens. Historically, whenever a developer undertook a real estate project, he would tie up 70, 80% of the financing. And then he would sell apartments whilst the construction was going on and use the money he collected on that sale to complete the project. Now, for a variety of reasons which we don't need to get into, sale of under construction property has slowed down. So the last mile funding that developers used to get, they no longer are getting. And that is why you're seeing so many projects all over the country which are 70, 75, 80% completed but are not getting that last bit of money to complete the project. Now, there are three ways in which such a project can get money. The first way would be if they were to sell apartments. So if a stuck project, more apartments were sold, then obviously the developer would get money and he would use that money to complete the project. But nobody is going to buy an apartment in a stuck project, realistically. Sure. So that doesn't happen. Second is a new lender comes in and provides money for that project, provide that last mile funding. There are a number of these projects where there is still equity which is left. There is still cash flow, they are still cash flow positive. It is possible for a new lender to come in, provide that last mile funding and complete the project. But the problem today is regulatory. From a regulatory standpoint, the regulations today say that if a project is a non-performing loan in someone's books, then anybody coming and providing fresh funding to that project, no matter what safeguards you take, no matter what security you've taken, no matter how well you ring-fence the money you provided, notwithstanding all of that, you have to classify the loan as a non-performing loan from day one. Now, if that is the case, there is nobody who is going to be willing to provide money for a project. So a stuck project cannot sell and a stuck project cannot get financed, so it remains stuck. So now the only way you can progress on this is the government has very correctly and very rightly, and I must compliment the government for that, set up this real estate fund of 12,500 crores where we've also made a contribution. So money can be provided by this fund to these stuck projects, but the problem is there are thousands and thousands of these stuck projects.
So it will take time to do due diligence.
It takes a very long time, or RBI has to permit a one-time faster solution would be a one-time restructuring of loans to be permitted by RBI, in which case a lot of these projects which are not getting funding from people will get the funding and the project can get completed.
Have you come up with any projects that you've seen but not lent into it, at least from a last mile financing standpoint, because of these rules?
There are lots of projects which we would not lend because of these rules, of course.
In terms of the AIFs that the government has put out, we're still waiting for the investment rules. Are there any idea on when the timelines for that would come out?
I think you have to ask the State Bank, which is monitoring it. My sense is that a few projects have been identified where they are going to fund, but I don't know the details.
Won't know when the first few deals will be closed.
Sure.
So in terms of loan default, some banks have been reporting that mortgages have gone into default over the last year. This could be because of economic reasons or a downturn or some situations in certain states. Have you seen that happen in your individual book?
In our individual book, gross non-performing loan has gone up. But it's gone up very, very, very minutely. So I would not worry too much about it. Our gross non-performing loans in September was 0.73%. In December, it stands at 0.75%.
But do you see any risks in that because the economy downturn, people are linking that?
See, at the end of the day, you have to understand that a real estate loan is a little different from a car loan or a consumer loan. You would default, if at all you were to default, you would default first on an unsecured loan or a credit card, then on a car loan, then on a consumer loan. The last default you would ever do would be on housing.
So just wanted to understand two entries in the P&L account of the company. First is the impairment on financial assets, which is just below 3,000 crores. And the other is a gain from the investments you made.
So let me explain to you. We used to own shares in GRU Finance. GRU got merged into Bandhan, and we got shares of Bandhan Bank, and that transaction got completed in this financial year. Now, IND AS, we are all required to follow IND AS accounting. That's Indian accounting standards. Under Ind AS accounting, at a time like this, we have to reflect the Bandhan shares at market price. GRU shares were always being reflected in the balance sheet at their historical cost.
Right.
But Bandhan has to be reflected at market price. The difference between the market price of Bandhan shares on that day and the carrying cost of GRU shares becomes the mark-to-market gain.
Sure.
Now, in the first week of January, we made an announcement to the market, which is there on the stock exchange, and I'm sure you have cognizance of that, where we had mentioned that we would have a 9,000 crore mark-to-market gain on this share. So that is the transaction. Provision, we've been just very, 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 very conservative in our provisioning. So we provided 2,995 crores. On a balance sheet basis, we now carry a provision of 9,964 crores.
So that 3,000 crores is off the 9,000 crore total provision?
Yeah, of course. So we've been very conservative in our provisioning, and we continue to remain very conservative.
So just in terms of impairment in financial instruments, what particular instruments are you talking about?
No, this is all loans only. No?
Okay.
This is impairment of financial instruments, terminology
it's
used by.
Okay.
It's a terminology which is used by the accounting standards.
Okay, so it's just provisions
nothing but
against loan
provisioning.
assets. Okay, I understand. Well, thank you so much for speaking to us.